What you are about to hear is not speculation. It is not fear-mongering for the sake of clicks, and it is certainly not something you will find splashed across the front pages of mainstream newspapers. This is the uncomfortable truth about the British housing market that very few people are willing to discuss openly, because when you start connecting the dots, the picture that emerges is deeply unsettling. Right now, as you watch this video, there are millions of people across the United Kingdom who are one missed payment away from losing everything they have worked their entire lives to build. There are families sitting around kitchen tables tonight, staring at bank statements, wondering how they ended up in this position after doing everything society told them to do. And there are landlords, the very people the media loves to vilify, who are quietly selling up, walking away from properties, and leaving a vacuum in the rental market that nobody seems prepared to fill. The question everyone keeps asking, the one that haunts dinner conversations and keeps people awake at 3 in the morning, is whether the UK is heading for a genuine housing collapse. Not a correction, not a slowdown, not a temporary adjustment, but a full-scale collapse that fundamentally reshapes who can afford to live where in this country. After months of analyzing the data, speaking to estate agents, mortgage brokers, landlords, and ordinary families caught in the crossfire, I'm going to share with you exactly what is happening behind closed doors, why the situation is more precarious than official statistics suggest, and what this could mean for you, your family, and your financial future between now and the end of 2027. Let me start by painting a picture that might feel familiar to many of you watching. Imagine a couple in their early 30s. Let us call them James and Sarah. They did everything right according to the traditional script. They went to university, accumulated modest student debt, found decent jobs in professional fields, and spent their 20s saving for a deposit while renting a cramped one-bedroom flat in a commuter town outside London. By 2021, they had finally scraped together enough for a deposit on a modest 3-bedroom semi-detached house valued at around £400,000. They stretched themselves, took on a mortgage that was 5 times their combined income, and believed they were securing their future. The interest rate at the time was just under 2%, which made the monthly payments feel manageable, even comfortable. They started talking about starting a family, about finally feeling like adults who owned something tangible. Fast forward to today, and James and Sarah are facing a reality they never anticipated. Their fixed-rate deal expired, and when they went to remortgage, they discovered their monthly payments would increase by nearly £800. That is not a typing error. £800 more every single month, simply to keep the roof over their heads that they technically already own. Their household budget, which had been carefully balanced, has been completely destroyed. The nursery they were planning to decorate is now just an empty room, because bringing a child into a situation where they can barely afford heating feels irresponsible. Sarah has picked up extra shifts at work. James has started doing freelance projects in the evenings, and their relationship is showing cracks under the pressure. They are not alone. There are hundreds of thousands of couples just like them across the country, trapped in properties they cannot afford to keep and cannot afford to sell at a loss. What makes this situation particularly cruel is the psychological dimension that rarely gets discussed. These are not reckless people who over-leverage themselves chasing dreams of property empire. These are ordinary citizens who followed the advice of financial institutions, government messaging, and societal expectations. They were told that property was the safest investment, that getting on the ladder was essential, that renting was throwing money away. Now they discover that the ladder they climbed has been kicked out from under them, and the same institutions that encouraged them to borrow are now charging them significantly more for the privilege of remaining in debt. The sense of betrayal is palpable when you speak to people in this situation. It is not just financial stress. It is an existential crisis about whether the fundamental promises of British society still hold true. Meanwhile, in cities like London, Manchester, Birmingham, and Bristol, the rental market has entered a phase that can only be described as dysfunctional chaos. The statistics you hear on the news do not capture the human reality of what is happening on the ground. When a rental property becomes available in a desirable area, There are sometimes 50, 60, or even 100 applicants within the first 24 hours. Letting agents are holding open viewings that resemble competitive auditions, where prospective tenants arrive with folders of documentation, bank statements, references, and sometimes even personal letters explaining why they deserve to be chosen. People are offering to pay 6 months or even a year's rent up front just to secure a property. Young professionals are being outbid by wealthy overseas students. Families with children are losing out to childless couples because landlords perceive them as lower risk. This is not how a healthy housing market operates. This is what happens when supply has been systematically constrained while demand continues to grow, and what we are witnessing now is the inevitable consequence of decades of policy failures catching up with reality all at once. The rental crisis did not appear overnight. It has been building for years, hidden beneath surface statistics that looked acceptable because they were averaged out across regions and property types. But now the pressure has become too great to ignore, and the people paying the price are those who can least afford it. Consider for a moment the position of landlords, and I know this is a controversial perspective that will attract criticism in the comments. The media narrative has successfully painted all landlords as greedy parasites exploiting the housing needs of vulnerable tenants. Some landlords absolutely deserve that characterization, but the reality is far more nuanced than the headlines suggest. There are hundreds of thousands of small-scale landlords in this country, people who own 1 or 2 properties as part of their retirement planning, who bought flats decades ago when prices were reasonable, who have provided stable long-term housing for tenants and maintained those properties responsibly. These landlords are now being squeezed from every direction simultaneously. The removal of mortgage interest tax relief has drastically increased their tax burden. Regulatory requirements have multiplied, adding costs for energy efficiency upgrades, safety certifications, and compliance with an ever-growing list of standards. Meanwhile, interest rates on buy-to-let mortgages have climbed sharply, in some cases doubling or tripling the monthly costs of holding these properties. The mathematics simply no longer work for many of these landlords. When your rental income barely covers your mortgage payment, when every maintenance issue represents a loss, when the threat of problematic tenants or extended void periods keeps you awake at night, and when the government seems determined to make your life more difficult with every passing year, the rational decision becomes obvious. Sell up and get out. And that is exactly what is happening on a scale that has not been seen in decades. Landlords are exiting the market in droves, and each property they sell removes a potential rental unit from the supply. Sometimes those properties are bought by owner-occupiers, which is positive for homeownership statistics but does nothing to help people who cannot afford to buy. Sometimes they are bought by larger institutional investors who have different priorities and different relationships with tenants. And sometimes they simply sit empty for extended periods during the sales process, contributing nothing to either the rental or the ownership market. This landlord exodus is creating a doom loop that policymakers seem unable or unwilling to address. Fewer rental properties means higher rents for those that remain. Higher rents mean more money flowing out of tenants' pockets each month. Less money for tenants means reduced ability to save for deposits. Reduced deposit savings means fewer people transitioning from renting to owning. Fewer buyers in the market means downward pressure on property prices. Falling property prices mean more landlords in negative equity. Negative equity means more distressed sales. More distressed sales mean fewer investment properties being purchased. And so the cycle continues, spiraling downward while everyone involved feels increasingly trapped and increasingly desperate. The construction industry, which should theoretically provide the solution to this crisis through increased supply, is facing its own existential challenges. House builders across the country are reporting sharp declines in sales, mounting inventories of unsold properties, and severe pressure on their profit margins. The cost of building materials remains elevated despite some moderation from the peaks of 2022 and 2023. Labor costs have increased as skilled tradespeople demand higher wages to compensate for inflation. Land prices, while softening in some areas, remain prohibitively expensive in the regions where housing demand is highest. And the planning system continues to create delays, uncertainties, and additional costs that make development projects increasingly risky and decreasingly attractive. Several major house builders have announced workforce reductions, site closures, and revised projections that point to significantly lower output over the coming years. Small and medium-sized builders, who historically contributed a substantial proportion of new housing supply, are particularly vulnerable. Many lack the financial reserves to weather an extended period of weak demand and high costs. Some have already gone into administration. Others are surviving month to month, hoping that conditions improve before their cash runs out. The consolidation happening in the construction industry will have long-term implications for housing supply that extend far beyond the current cycle. When small builders fail, they take with them institutional knowledge, supplier relationships, and the capacity to deliver the kinds of smaller development projects that often provide the most affordable new homes. What concerns analysts most deeply is the potential for these various pressures to compound and accelerate in ways that models struggle to predict. Economic systems are not linear, and housing markets are particularly prone to tipping points where gradual decline suddenly becomes rapid collapse. The factors that could trigger such a cascade are numerous and interconnected. A significant recession causing widespread job losses would immediately impact mortgage affordability for millions of households. A banking crisis, perhaps, originating overseas but quickly spreading through global financial networks, could freeze mortgage lending and trap buyers and sellers in suspended animation. A geopolitical shock affecting energy prices could reignite inflation just as central banks were preparing to cut interest rates. Any of these scenarios, or combinations thereof, could push a stressed housing market past its breaking point. The period between now and 2027 is particularly concerning because of the structural challenges that will intensify rather than resolve during this time frame. Approximately 1.5 million fixed-rate mortgage deals are due to expire in 2025 alone, with similar numbers in 2026 and 2027. Each of these households will face the shock of transitioning from rates locked in during the era of cheap money to rates that reflect the new reality of persistent inflation and higher base rates. The cumulative impact of these remortgaging waves will extract billions of pounds from household budgets that might otherwise have been spent in the broader economy. This reduced consumer spending will affect businesses, employment, and ultimately the government's tax revenues, creating a feedback loop between housing costs and economic performance. London, which has historically been both the engine and the bellwether of the UK property market, presents a particularly complex picture. Prime central London, the zones favored by wealthy international buyers, has experienced significant price corrections from the peaks reached in 2014 and 2015. The combination of Brexit uncertainty, stamp duty increases for overseas buyers, and shifting preferences among global elites has reduced demand for the most expensive properties. Some areas have seen price declines of 20 or 30% in real terms, though nominal prices often mask this reality through extended selling periods and behind-the-scenes negotiation. But Outer London and the commuter belt tell a different story. These areas saw explosive price growth during the pandemic as workers sought more space while expecting to work remotely permanently. Now that employers are demanding returns to offices, some of these pandemic premiums are unwinding. Properties that sold for inflated prices in 2021 are now worth less than what their owners paid, trapping them in negative equity and preventing them from moving even when their circumstances require it. The human toll of this situation cannot be adequately captured through statistics alone. When I speak to people affected by the housing crisis, what strikes me most is not the financial details, but the emotional weight they carry. There is shame involved, a sense that somehow they should have known better, should have predicted the unpredictable, should have been more conservative in their borrowing or more aggressive in their saving. There is anger at a system that seems designed to benefit those who already have wealth while extracting maximum value from those still trying to acquire it. There is fear, sometimes bordering on panic, about what the future holds and whether there will be any safety net if things continue to deteriorate. And underneath all of this, there is a profound exhaustion from constantly worrying, constantly calculating, constantly trying to stay one step ahead of circumstances that seem determined to overwhelm them. First-time buyers face perhaps the most daunting landscape of any generation in living memory. The traditional path to homeownership, saving a deposit while renting, and then stepping onto the property ladder in your 20s or early 30s, has become mathematically impossible for most people without family assistance. Average house prices in many parts of the country now exceed 10 times average earnings, a ratio that would have been considered absurd just 2 decades ago. The deposit required for a modest first home often exceeds what a typical worker could save in a decade, even living frugally and prioritizing saving above all else. And even those who somehow accumulate sufficient deposits face mortgage affordability assessments that have become significantly stricter in the wake of the cost of living crisis. What we are witnessing is not merely a temporary affordability challenge, but a fundamental restructuring of British society along lines of intergenerational wealth. Those born to property-owning parents can expect assistance with deposits, guaranteed inheritance of valuable assets, and the security that comes from knowing there is a family safety net. Those born to renting parents face the prospect of renting forever, transferring wealth to landlords throughout their working lives, and entering retirement without the asset base that previous generations took for granted. This bifurcation of society into property haves and property have-nots carries profound implications for social mobility, political stability, and the basic sense of fairness that underpins the social contract. Pensioners and those approaching retirement are not immune to these pressures. Many older homeowners viewed their properties as their pension, expecting to downsize in retirement and release equity to supplement their income. But downsizing has become less attractive as smaller properties have increased in price relative to larger ones, and the transaction costs of selling and buying eat into the proceeds. Others plan to use equity release products, but rising interest rates have made these arrangements more expensive and less generous. And those pensioners who remain in the rental market, having never owned property or having sold earlier in life, face the terrifying prospect of competing for housing with their pension income, while rents continue to climb far faster than their state pension or savings income. The government response to these mounting pressures has been inadequate to the scale of the challenge. Various schemes have been announced, consulted upon, and sometimes implemented, but the fundamental dynamics driving the crisis remain unaddressed. Building new homes requires political will that repeatedly fails to materialize when faced with local opposition from existing homeowners who benefit from restricted supply. Reforming the rental market to provide greater security for tenants risks accelerating landlord exodus and further constraining supply. Intervening in mortgage markets to protect struggling borrowers creates moral hazard and distorts price signals. Every potential solution creates new problems, and policymakers seem paralyzed by the complexity and the political risks of meaningful action. As we look toward 2026 and 2027, the trajectory appears concerning. Interest rates are unlikely to return to the near-zero levels that prevailed for most of the 2010s, meaning that the structural affordability challenge is permanent rather than temporary. Demographic pressures continue to build as the population grows through natural increase and immigration, while housing supply fails to keep pace. Climate change is adding new considerations to property values, with flood risk, subsidence, and energy efficiency becoming increasingly important factors in valuations and insurability. And the broader economic outlook remains uncertain, with the UK facing persistent challenges to productivity growth, trade relationships, and public finances that could easily tip into recession given the wrong combination of circumstances. What does all of this mean for you watching at home? It means that the decisions you make in the coming months and years could have profound consequences for your financial security and your quality of life. It means that assumptions that held true for your parents and grandparents may no longer apply in a world that has fundamentally changed. It means that the property market you thought you understood has transformed into something more volatile, more unpredictable, and more unforgiving than anything previous generations experienced. Whether you are a tenant hoping to buy, an owner worried about your mortgage, a landlord questioning your investment, or a pensioner trying to preserve what you have built over a lifetime, the ground beneath your feet is less stable than it appears. The question posed in the title of this video does not have a simple yes or no answer. A housing collapse, in the dramatic cinematic sense of prices having overnight and widespread repossessions, would require a combination of catastrophic circumstances that remains unlikely, though not impossible, but a grinding, extended deterioration that slowly erodes wealth, destroys dreams, and restructures society in ways that benefit the already wealthy at the expense of everyone else is not merely possible, it is already underway. The collapse might not arrive as a dramatic crash, but as a slow-motion disaster that unfolds over years, with each month bringing fresh challenges and diminishing hope for those caught in its path. If you have found this analysis valuable, if it has helped you understand the forces shaping your housing situation and your financial future, I would ask you to subscribe to this channel and turn on notifications. The situation I have described will continue to evolve, new data will emerge, and the consequences will become clearer as events unfold. Staying informed is not just intellectually satisfying. It is practically essential for navigating what promises to be one of the most challenging periods in UK housing market history. Share this video with friends and family who need to understand what is happening and why. The mainstream media will not explain these dynamics clearly, because doing so would require acknowledging uncomfortable truths about policy failures, institutional priorities, and the fundamental unfairness embedded in how our housing system operates. The months ahead will test the resilience of millions of British families. Some will navigate successfully, adapting their plans and finding ways through the storm. Others will face genuine hardship, losing homes they